Welcome to the very first episode of our new series, So You Want to Start a Business. At the Center, we're a full-service business and transactional law firm. Tax planning is at the heart of what we do, but we don't stop there. We help with transactions, business structuring, succession planning, real estate, intellectual property, and just about anything that comes with businesses. Think of us as a one-stop shop where legal meets accounting. My name is Allie Schramm, and I'm an attorney. I also coordinate our firm's educational initiative. I'm here today with Roman Basi. He's the president of both of our accounting and legal firms. He's the managing member of Woodland Rental Properties, the managing broker of Heartland Realty and Rentals, a title insurance agent, a private pilot, amongst other titles. Starting a business is exciting, but it's also a little like building a house. If the foundation isn't solid, the whole thing can start to wobble. And let's face it, no one wants to find cracks in the wall 6 months after they've moved in. In this series, we're going to walk through the core legal and tax matters every entrepreneur should understand. Choosing the right entity, making smart tax decisions, handling contracts, planning for growth, preparing for disputes before they happen, and considering the future of the company.
Thanks, Allie. Thanks for the introduction. And it's great to have our first session here as we start to kind of roll these out for all of our clients, potential clients, and all of our anyone wanting to learn some information about companies.
I want to give the disclaimer that the information provided today is for general education purposes. It's not legal, tax, or accounting advice and doesn't create an attorney-client or a CPA-client relationship. You should consult with your qualified professionals regarding specific circumstances unique to you before making any decisions based on the information today. Today's episode starts with the very basics of an entrepreneur's journey from a legal perspective. Most clients and friends approach me wanting to start an LLC. How does someone decide between an LLC, corporation, or other structures when forming a business?
When we talk about starting up a company, there's certain things that people think about. And we get a lot of phone calls to say, hey, I want to start an LLC, and what do I need to do to start that LLC? Well, and first of all, we usually tell them, hey, that's the wrong question to be asking. When you want to start a company, you're thinking about starting a company, there are different types of entities to be thinking about. So we start with the basics and we say, and the first question we're going to ask you is, what are you doing? What is the business? What is the idea? Where are you at with your business plan or your thoughts in your head? And from that, we'll formulate and say, okay, the different types of companies that we can create for you. We start out with what's called a sole proprietorship. And a sole proprietorship, there's really nothing that has to be done with a sole proprietorship. You don't have to incorporate it at the state level. You don't have to file anything. You can simply say, okay, I'm going to start a business and I'm going to use it as a sole proprietorship. And we'll talk later about the types of tax forms that would require, but that's the easiest business to start as a sole proprietorship. Don't always recommend that because you don't get corporation protections. There's not as many tax advantages to those as well. So then we think of things like S corporations or C corporations or limited liability companies or partnerships or trusts. There's these different types of entities that you can form and create legal protections and tax advantages. So when we talk about S corporations or C corporations, the reason why we use those acronyms for them or those letters for them is that is where they come from in the Internal Revenue Code. It is Chapter S of the Internal Revenue Code. So we call them S corporations or C corporations. If you come to me and you say you want to form a limited liability company, then a limited liability company can be formed. It can be formed at the state level. However, it still has to pick whether it wants to be a sole proprietorship, a S corporation, or a C corporation, or a partnership. A limited liability company itself is not necessarily recognized at the federal level. So while you file it at a state level, and I don't want to get too far ahead of ourselves, but especially with limited liability companies, because we get that question all the time. I just want listeners to know, to say, hey, there are different types of corporations. And even if you look at a limited liability company to file, you still have to pick at the federal level what you want that company to be at the federal level. So just in general, that's an introduction of what types of companies exist. Now, there's going to be a lot of reasons as to why you would pick what type of company that you want to be. And again, those reasons, we're going to direct you as to those reasons Okay, what do you want protection legally? What's the business going to be? What are the taxes that are going to be imposed on the business? What kind of advantages can we get from these different entities? Each entity has its own specific tax attributes. So that's just a general introduction into what different types of entities we're going to look at to choose for a business.
We understand that when you go to file your company, you have to decide what kind of company you want, and that's separate from the taxation. What are the different considerations that come into mind when you're making an election on how you want to be taxed as a new business? What are the impacts on liability and cash flow? Can you tell us a little bit about that?
That's a great question, because the second thing we look at is say, okay, now you've told us maybe what your business is going to be. Now we've laid out what types of companies there are. So let's talk about what legal protections exist first. For a sole proprietorship, let's start there. A sole proprietorship, what legal protections exist for the business? In other words, if the business were to be sued or have a problem, are you, the owner, going to be personally liable for that lawsuit or that claim or that problem? Under a sole proprietorship, the answer is going to be yes. You're going to be liable for that claim or liability. Now let's switch gears and say, okay, what if I'm a corporation? And I say, I'm going to be a corporation. I'm going to either file my company as an S corporation or as a C corporation. And from a legal standpoint, the answer then is, are you going to be liable for legal claims of the business at a personal level? And the answer is this: if you do things correctly, then you should not be personally liable for claims against the company. Now, again, not getting too deep today, as we're going to have a lot of sessions for everyone in the future, but we're going to talk about things like personal guarantees down the road, where you might be personally liable for claims against the company if such a thing as a personal guarantee exists. But in most cases, if you set up a company as an S corporation or as a C corporation, you can create what we call a liability shield around yourself as an individual. And any claims against the business are not going to be claims against you as an individual. So if the company owes a creditor a debt of $100 and the creditor sues you, the business owner, you may not be personally liable if the business is now out of business or dissolved or bankrupt or whatever it may be. You may be able to avoid that liability in the future should things not go your way. So for an S Corp or a C Corp, that's the kind of legal protections that it creates for you. And that's a very good thing. Let's talk about the limited liability company then. So a lot of people say, I want to be a limited liability company. And I teach this. Many of you listening today probably know I speak across the country to audiences, and I'm teaching this information to business owners across the country. Let's talk about a limited liability company. A limited liability company means exactly what it says. There is limited liability. Why, as an owner, would I want any liability? If I have an S Corp or a C Corp, as we just talked about, and we'll talk about how we get those later. How do you get the different corporations? And I'll go into the tax part of it here in just a minute, which will understand why you want to be one of those. But if I say, hey, I've got an S Corp or a C Corp and I run it appropriately and I'm not personally liable for anything, then why do I want to be a limited liability company and have potential some liability? That's what it means, right? Limited liability. Now, in each state, limited companies are created at a state level. So a lot of you listening are from different states. A limited liability company, their liability is going to be dictated by the state law. But in general, an owner of a limited liability company can be personally liable up to their investment in the company. That's just a general rule that I kind of would preach when I talk about limited liability companies. So if you say to yourself, well, I don't want any liability. Why would I want any liability personally to myself? Well, then we don't want you to be a limited liability company. The reason why we would is there are some tax benefits to certain types of companies if they are limited liability companies, but it doesn't extend to all of them. So we don't always want a person's business to be a limited liability company. And then we can talk about, well, you can be a partnership. A partnership, if you're in partners with another person, you can have a partnership. You can file a partnership at the state level and become a true partnership. And you file a tax return for a partnership. It does not have to pick whether it's going to be an S corporation, a C corporation, a disregarded entity, or anything of that nature. So you have that ability as well. Now let's step back a second. In a lot of cases, and I know I'm speaking to a lot of you probably listening today, you may have a limited liability company, but you may be what we call disregarding it as an entity. And therefore, you filed it as a limited liability company with your state, but for tax purposes, you're saying, hey, I'm going to disregard the fact that it's a company, and I'm going to file my tax return for my company on my personal return, and I'm going to call it a disregarded entity. Again, let's not get too confused today and get too ahead of ourselves, but I'll tell you this, when you do that, you are lessening the liability shield around yourself again in another matter. And there are so many business owners that come to us that practice and they have an LLC, and they are filing the LLC on a Schedule C on their personal tax return. So they have liability with the company because they're a limited liability company. And now they've shed all the rest of the liability essentially because they're calling it what we call a disregarded entity, which becomes essentially a sole proprietorship. So again, you have these sole proprietorships, S Corps, C Corps, limited liability companies filing as a sole proprietorship, and we're just destroying the personal liability shield that we created when we filed it as a limited liability company. Those are the legal things we look at. So what do we want legally for someone's business, and how best is it going to set it up?
You mentioned that as long as you're doing things the right way, in a corporation, you can avoid personal liability. Can you tell us a little bit about what it means to do things the right way, especially when it comes to setting up your company?
When we talk about saying setting things up right and doing things the right way, in order to create corporate shield protection for yourself, you've got to follow what the rules are. And you really should. Some of the rules are you can't act like an alter ego of yourself, or you can't be what we call undercapitalized of the business. And I tell my clients this, you can't be out there doing $1 million contracts and only have $1,000 of cash in your checking account. A court's going to say to you, look, you're not really doing things the right way. You're not talking, walking, and acting like a corporation. So one of the very first steps we want to do is we want to look at filing things for the corporation the proper way. We want to have all the corporate formalities in place. We could do a whole session on corporate formalities, but we talk about, look, did you file the right papers at the state level? And we could talk about that in a few minutes. Did you file the right papers at the state level? Do you have what's called a corporate record book? Are you following corporate formalities? Are you acting like a corporation? It's not just an alter ego of yourself. Are you commingling your assets? Are you putting your personal money in with your corporate money? Do you have a corporate bank account? Commingling of assets. You're not going to have those corporate protections if you do that. And then, like we said before, are you undercapitalized? Yeah, I'll give you an example. My daughter just started a business, and when she started the business, she called me and she said, "Hey, Dad, do I need to have a business account, a business checking account for myself?" And I said, "Well, Lexi, what type of business are you?" And Lexi said, "Well, I formed an S corporation, or at first, actually, she formed a limited liability company in Tennessee." And I said, "Why would you do a limited liability company?" And so she formed an S corporation in Tennessee, just like we went over today. And I said, yeah, you have to have a corporate checkbook, because if you don't have a company checkbook and you're putting your company money in with your personal money, then you're commingling your assets, and you could lose that protection that you're trying to create. You're not doing things the right way. And the right way is by what we call following corporate formalities. Now we'll shift gears and we'll talk about the tax. How do we decide on an entity for tax purposes? So we looked at legal purposes, and now we're going to look at tax purposes. If we file it as a disregarded entity or a sole proprietorship, that means we are going to file the taxes on a Schedule C on your personal tax return. So when you file your tax return at the end of the year, that is Form 1040. And when you file your Form 1040, you're going to attach what we call a Schedule C. So the Schedule C is going to say, hey, this is your profit, or this is your loss for the company. So again, you can file that as a disregarded entity. There are still tax benefits to that. You can still take things like depreciation, and you can still create other benefits that way. But it's not necessarily the best way, because what did we just talk about? If legally I have a Schedule C and a disregarded entity and a sole proprietorship, I'm showing everyone that I don't really think it's a company, and I'm filing it on my personal tax returns. So it's not really a recommended way to file a company. For an S corporation, when we talk about tax benefits and why would we want you to be an S corporation and what does that mean? An S corporation means that the profit or loss of the business is not taxed at the business level. The profit or loss, what we call, flows through to your personal tax return, and you file the profit or loss on your personal tax return. Now, the business files a tax return. It's called an 1120S. And that, so if we make $100 of profit in a year, then the $100 of profit will show up on our 1040, and we will pay tax on that $100 at our personal individual income tax rates at our federal and state level. Now, there's a benefit to S corporations right now, and the benefit was just made permanent by the big, beautiful tax bill. The benefit is, if I made $100 of profit in an S corporation, I don't have to pay tax on 20% of that. It's called the qualified business income deduction. And so we take the $100 of profit and we file it on our 1120S tax return, and we only show $80 on our personal tax return that we have to pay tax at our personal tax rates. Now, why did I kind of emphasize those words, personal tax rates? Because I want you to know that, yeah, the highest personal tax rate we have at the federal level right now is 37%. And where does everybody live? You live in California, where you have a 13% income tax rate, or do you live in Illinois, where you guys have it, where Ali is talking to us today from our home office in Illinois, where you have a 4% tax rate, or do you live in Florida, where I'm at right now in Florida, and I have a 0% tax rate? So whatever tax rate that is, that $80 that shows up on your personal tax return that comes over from the federal tax, from the company tax return, excuse me, is taxed at that high. That can be a pretty high rate, right? Because you're taking your federal and your state. So we take that into consideration and say, do you want to be an S corporation? You're going to get 20% tax-free, but you're going to pay personal income tax rates on that profit. So then we look at a C corporation. So as we said, like, you've got sole proprietors, S corps, C corps. We look at a C corporation. A C corporation has that same $100 of profit, and it files a tax return. And that tax return is called an 1120. And on that tax return, it shows $100 of profit. And guess what that C corporation has to do? It pays taxes on that $100 at 21% tax rate right now. That's changed over the years, but right now we have a flat 21% tax rate on that $100. Now, you pay $21 in tax on that. Now you have $79 of profit left. In a C corporation, and this is where a lot of, honestly, and Ali, this is where a lot of private business owners get all of this wrong, because they say, well, I don't want to be a C corporation, because in order to get that $79 out of the C corporation, I have to give myself a dividend. A dividend is not deductible to the C corporation. So in other words, they pay tax on $79, and they're going to give the owner a dividend of $79. So they didn't get to deduct it. And now the owner has to pay a dividend tax, which can be a lesser tax rate than an ordinary income tax rate, but they have to pay a dividend tax on receiving the $79. But that's where private business owners get this analysis wrong. How many people actually pay tax on a C corporation's profits when they are a private business owner? That's what's called double taxation. So they take the $79 out, and they pay a dividend tax on their personal tax return, and they pay the 21% tax on their corporate tax return, and they pay double taxation. And that's why people are scared of C corporations. But in the real world, and if you have a competent, advisable tax advisor that you're working with, or a CPA or an accountant, that's $79 over here on a corporation's tax return. An owner is going to take that out as salary, bonuses. They're going to expense that money out. So then they're going to take that $100 at 21%, because the C corporation does not get the 20%. They do not get the 20% QBI deduction. They only have to pay tax on 21% of that $100. Then they're going to take that $100 out, and they're going to say, okay, I just paid tax on the $100 at 21%. And now I'm going to take that back out. I'm going to take that money out as salaries, bonuses, dividends, and I'm going to be able to deduct the $100. So now what do I have? I have $0 at the C corporation rate, and I don't have to pay any of the 21% tax rate. So I made $100, but I deducted that all out of my C corporation's rate. I can move that $100 now over to myself. And what do I pay? The same as if I would have paid it as an S corporation. Now I may take it out as salary. I have salary, I have regular income, and I'm paying it as regular income. So in a C corporation, in a private company, we don't actually usually have double taxation. We only have double taxation if we are paying ourselves a dividend. And that's what I want the owners to know, to say, okay, then what's going to be my effective tax rate? We're going to look at all those differences when we make a decision. Let me just throw something out there, and this will be down the road when we talk about these things. We talk about things like back end taxation. There may be reasons why we say to you, look, we want you to be a C corporation and pay a flat 21% in tax for the company, because in 5 years, you're thinking of selling the company. And because you're a C corporation, we can set the C corporation up in 5 years so that you don't pay tax when you sell the business. So depending upon the type of business it is, what you want to do with the business, now you can see where all these complex questions come in. And so we make a decision. What do we want you to be? Do we want you to be an S Corp and take that 20% qualified business income deduction and only pay tax on $80? Or do we want you to be a C corporation and pay tax on $100 and then flow the money over to you personally? What do we want you to do as a corporation? And then finally, of course, we look at limited liability companies. And again, then we have the same question, because they have to pick how they want to be taxed. So many business owners call me and they say, hey, Roman, I want to be a limited liability company, or I am a limited liability company. I say, well, how are you going to be taxed? And they're like, I don't know, I'm a limited liability company. A limited liability company still has to pick how it's going to be taxed. Is it going to be a sole proprietorship? Is it going to be an S Corp, or is it going to be a C Corp? So we still have those same questions to look at when we look at a limited liability company. And then finally, with a partnership, that is treated as, if you do a partnership, so you're filing what we call a 1065, that is treated just like a sole proprietorship. It is shown on the tax return, and you pay tax at your personal tax rates. And again, let me step back a second. With a sole proprietorship or a 1065 partnership, showing that on a regular tax return, you are eligible, if you're the right type of business, to also get that 20% profit deduction. So I know that gets a little complicated there, and I didn't want to get as too complicated today, but hopefully everybody understands that there are some major things that you have to look at when you're saying, what type of legal entity do I want to be, and what type of tax entity do I want to be? Those are really two separate questions.
We talked about like the who and the what and the why. Let's talk about the where a little bit. I have a lot of clients that come to me wanting to establish a Delaware limited liability company. What does it mean to establish a Delaware company when you're not in Delaware? And where should someone consider both registering their business and forming their business?
That's a really good question. We get that a lot, from our clientele across the country. They say, okay, you've told me what type of company to be for taxation purposes and legal purposes. And then when they say, well, I want to file a Delaware company. And we always wonder, why do you want to file a Delaware company? And again, what are you doing? Where are you located? You can file your company in any state you want, in theory. And a lot of people will do that. And just to say, why do you say Delaware, Roman? Well, Delaware has one of the most established, protected laws in the country to protect corporations and protect owners of corporations. So a lot of attorneys say to us, well, I file everybody in Delaware. And while we have that choice to file a company in any state where we are, states have laws, they have nexus laws, and they have registration laws. And if you are doing business in a particular state, then even if you've filed as a Delaware corporation or Nevada corporation, and let's say we're in Illinois and we're doing business in the state of Illinois, then we are required to file that company as a foreign entity registered in the state of Illinois. And something I learned from an attorney that was with us for a long time and a very good, a very well-known attorney in our area in the Southern Illinois region, and was a very was a mentor to me over years in courtroom litigation tactics and just and company practices as we learn. He taught me, he said, Roman, in the courtroom, and he did a lot of litigation and I didn't. And he goes, in the courtroom, if a company is not registered in the state where they're doing business, and they're registered in Delaware, but they're not registered in Illinois, and they're doing business in Illinois, he goes, I can add a part to the complaint in the lawsuit, and I can add what he called a consumer fraud count in the lawsuit to say, look, they said they were a company in Illinois, but they're not registered in Illinois. They may be a Delaware company or a Florida company, but because they're not registered in Illinois and they're doing business in Illinois, I can add a consumer fraud complaint or consumer fraud aspect to the complaint, to the lawsuit, and sue them for attorney's fees on the lawsuit. Boy, did that open my eyes. He probably taught me that 15, 20 years ago. And he said, you've got to be registered in the state you're doing business. So one of the things we look at is we say, hey, just because you want to be in Delaware, what are you doing? And should you be filed in these other states? And then does it make sense to try to grab some out-of-state legal protection and have 2 filing fees or 3 filing fees or 4 filing fees? So we will look at that too. And so most of the time with our clients, we end up saying, okay, you're going to be located in Illinois. Let's just file in Illinois. Let's not be a Delaware company. Let's be an Illinois company only. Why have the 2 filing fees if it's really not going to benefit you? So you're right. The where is a big question. Once we know what we're going to file, where we're going to file it is the next question.
Roman, if there's more than one owner in a company or 2 people looking to start a business together, what key conversations and agreements need to happen right away to avoid future headaches and problems down the road?
And this comes up a lot as well. So if you are going to have a partner in your business, now if it's a spouse, that's the only time this may not necessarily apply, but it can be helpful to apply as well. But let's just say it's not a spouse. The key document that's really needed between partners is what we call a buy-sell agreement. Others may call it a partnership agreement or a shareholders agreement. But the real key terms are what we call a buy-sell agreement. And what a buy-sell agreement is if one of us decides to get out of the business, or one of us gets sick, or one of us passes away, or maybe we're both considered working in the business and one of us decides not to work anymore in the business, a buy-sell agreement tells us how we're going to split up the business, or what value, if I'm going to leave the business, what value I'm going to get for my interest in the business. Those events are what we call triggering events. And we want to make sure that we know between partners, if I put $100 in and you put $100 in, and we started the company with $200, and now the company's worth $500, how are we going to divide that $500, or how are we going to determine what the company's worth, and how are we going to divide that? That's what a buy-sell agreement does. It tells you how you're going to get out of the company. It tells you how much the company is going to be worth, and it tells you how you're going to be paid. Is it all at once? Is it over time? Is there going to be a loan taken out to pay you? We want owners to consider all of this up front. It can really, really avoid costly litigation. We have seen companies come to us that have had no buy sells, or even recently we had a company come to us and they said, okay, my dad started a company with a partner. My dad has now gotten really sick, is in the hospital and can't take care of himself. So now there's 3 sons running the company for the one dad, and the partner and him they want to split up the company. Oh, and by the way, that company had a buy sell, but they formed 2 other companies years later, and those 2 companies don't have a buy sell. And in that particular case, I would venture a guess that those parties have spent over $100,000 in legal fees trying to figure out what the value of those companies are, how they're going to split that up, there was a buy-sell agreement for one of the companies. It was very, very poorly written. And the other companies they formed later on did not have a buy-sell agreement. So it is the most important document between partners that are going to have a company. So you talked about, you asked about doing things right. It's about figuring out what type of company you want, where to file it, how to file it, and what internal documents are needed to run the business. And if you do it right, you will save yourself. I mean, you can save yourself hundreds and hundreds of thousands of dollars down the road if the company gets successful and you have to have for some reason, the parties are breaking up or they're selling out or whatever it may be.
That's a great summary of the key points and key takeaways for our discussion today. I hope everyone found the information helpful, and we'd love to hear feedback and any topics you might find important. Again, here at the center, we help entrepreneurs build strong foundations with legal and tax strategies done right from day one. Reach out to us if you're ready to take the next step.